Today's market call is presented by CME Group, where risk meets opportunity. And FactSet, financial data and analytics powered by tomorrow. Thursday, January 23rd, 1 o'clock on the East Coast. Dan, Nathan, Guy Adami. I'm not going to mess around today because we're on a tight schedule. But what I'll tell you is the following. Jacob's here. He's sitting 4 feet away from me.
Amazing.
And Bill Hochman was just in studio as well.
Always here.
And I said to him, do you know the song Train, Train by Blackfoot? He had no idea. But I played it for him, and then I started singing it simultaneously.
Yeah.
And he said, Bill said, well, you're in a band? But he said it like, oh, my God, you actually can sing.
I don't know. I don't know if I take that.
But maybe one show I'll just sing songs.
Well, that was what Danny Moses used to do for us on the tape
but
podcast.
Danny sings like in somebody else's voice.
Correct. He's very
I
good
sing
at it.
in my voice.
Yeah.
Anyway, it's market call. It's 1 o'clock on the East Coast, and there is a lot going on. Seemingly, and the market continues to sort of take its lead from comments coming out of now President Trump. Maybe for the best, maybe for the worst. My concern is like he's using up a lot of his material real early on, and one has to wonder when we hit the point of diminishing marginal returns in terms of the rhetoric, the language, the news announcements, the press conferences, and its impact on the market.
Yeah, I guess, listen, we get it. He's done this before. We've seen this play out of the playbook. You know what I mean? I'm not so sure there's going to be too many sort of, I don't know, riffs on that sort of playbook. It's taxes here, it's tariffs, right? It's threats of, a whole host of things on the trade front, right? And then it's kind of pressing OPEC to get, oil prices lower, pressuring Fed Chair Powell to move interest rates lower. They say they want a strong dollar. I don't really believe that. If they want interest rates lower, that what comes with that, guy?
Well, one would think if lower interest rates going to mean the dollar's going lower as well. I mean, there are a lot of cross currents here. I think today, the market seemingly enjoyed the fact that if you were to build your plants here, build your businesses here, 15% corporate tax rate. I mean, all very friendly things. One has to wonder the implementation, but right now the market doesn't care. We have a VIX below 15. We have the S&P 500 at 6,100, and it's all systems go right now.
Yeah, and I had a conversation on the tape podcast with my friend Tommy Vitor.
I love Tommy Vitor.
He's the man. He actually was really bummed that you were not here, guy.
I doubtful.
He most definitely was. But we're talking about like what President Trump has inherited, right, from the last administration here. So, and we talked about it on Fast Money a little bit. So you have 4.1% unemployment. While it's up a bit, it's still historically at lows. You have, again, cumulative. I get it. But CPI inflation readings have come down dramatically. There's many folks who believe it's on its way to the Fed's 2% target. You have GDP growth, which surprised almost everybody last year at 3%. And you could say at 2.5% expectations this year, it might get back up to 3%. You have a stock market at all-time highs. So things seem really good on the economic front. We know that there's tons of stuff under the hood that might not be great. But Guy, even I've noticed a difference in tone. You and I talk every day. We podcast every day. You've had definitely a difference in tone over the last few months about the economy. And I'm not saying you're kind of shifting gears or anything like that, but I think you've been more open to other outcomes other than a recession. Does that make sense?
No, it is fair. I mean, I've been surprised by the resilience without question. I'm still concerned by some of the things that I read and see in terms of delinquency rates and bankruptcies that are levels we haven't seen probably in 20 years, and a number of different factors that should be concerning for everybody, but are not concerning for the market. So I find myself scratching my head as to why they're not impacting and why this lag effect in terms historically what we should see has taken as long as it has. And I think there's a school of thought that, I'll use the term, maybe it's different this time. I'm just hard pressed to believe it was. And you mentioned, President Trump is also inheriting a stock market at an all-time high, but he's inheriting it with all the things we talked about yesterday, those 8 metrics. They're in the 98th to 100 percentile in terms of being overbought, expensive, excessive, whatever term you want to use. And that sort of juxtapose what we saw in January of 2009 when those same metrics were either 0, 1, or 2%, meaning that things were completely overdone to the downside.
Yeah, and I guess one thing that strikes me here, and there's a level of complacency as it in regards to risk assets, right? And to your point, if you have a report like we just highlighted yesterday showing, all those metrics that you just talked about as it relates to just the markets, and there's a level of complacency despite like some of warning signs, flashing pretty hard. And then there seems to be, as it relates to the economy, still some trepidation, right? Does that make sense? So there's, exuberance about markets, and there's a bit of FOMO going on. And then the flip side of it, there does seem to be, some, fear of the economy really softening or rolling over.
That fear is justified. But I think, again, this administration is going to do the best they can to assuage those fears. They're going to do it with rhetoric, with action, and we'll see if it all works. I mean, you said this is, and we as citizens of this country, we have a vested interest for whomever is president and the administration to do well. So I'm rooting for whoever is sitting in the seat. My concerns are around some of the rhetoric, some of the implementation, some of the things that I think are going to be dangerous. His want for lower interest rates. He could talk about lower interest rates all he wants. I mean, I believe the Fed could have a meeting today and say, you know what? We hear you, President Trump. We're lowering the rate by 50 basis points. I think 10-year yields would go up, which is counter to what people want to happen. So, let's see.
It's funny. I mean, you've been saying this for months and months, is like, if you lower the Fed funds rate, right, and that kind of stokes inflation, well, that's exactly what yields are going to do. And that's exactly what they happened over the last 5 months in September. Listen, and we said this last time in Fast Money, like, we are all rooting for the economy. Right? We are all rooting for the stock market to basically stay at reasonable levels, not to correct in a meaningful manner, but we know that happens. And so when you think about that, I guess the risk is that he likes to push things around. He likes to push people around. He likes to pick winners and losers. And what we are going to be susceptible are to tape bombs, right? Well, what is a tape bomb? It's like he's speaking somewhere, you're not even paying attention. Or this morning, he's speaking to Davos, like the world leadership, right? And he says something that gets everybody a little nervous, or those are going to happen, and you can try to normalize it, but I think every once in a while there's going to be something that's substantial.
By the way, I think it happens by design as well, because a lot of times, there are people that like to create problems and then subsequently fix the problems that they create. And I believe that he potentially is one of those people. We'll see. Anyway, we're not here to pontificate. Let's look at
there's a little pontificating.
Little. Well, I guess what we do in general is pontification. But let's take a look at some of the charts that Amanda made, because she's going to get mad at me if we don't.
Sure.
So obviously it's CME day. So let's take a look at the S&P E-minis, because, again, we traded down that support level. Would have been nice if we went down to the 150-day. We didn't. Probably close enough. Obviously pushing up towards the all-time high, which we made yesterday, back to those prior highs that we saw in the middle of December or so. I mean, this looks constructive. It's hard to say this doesn't look constructive, Dan.
Yeah, I guess if you just look at that trend line, back to your point, it was support. It broke it. It kind of held the levels from the breakout of early November, right? And again, that looks like a consolidation for all intents and purposes. So here we are at that upper bound, right? So you see that at like 61.30 or so, and then that uptrend turns into resistance, right? And so let's just see how it acts. I think that, again, that 150-day moving average, you see where it got down to just a couple weeks ago, bounced right off those sorts of levels. So you have the levels to kind of play against, if that makes some sense.
Listen, pull up that Griffin. I think it was Griffin to pull it up, and he said, I think he did it with TikTok, maybe not so much with the ceasefire, but that's what I'm talking about, Griffin, those types of things. So put that chart up real quick again, Amanda, and we'll go to the next one in a second. But what could potentially happen here is we were in this uptrend since August. We broke the uptrend, traded down to the 150. Basically, we're trading back to that uptrend line. Worst thing that could happen here is we trade back to the uptrend line and fail, and then head lower. Carter Worth talks about formations like that all the time.
Yeah, so let's just keep this up for a second. So we're 61.30. Let's just say you're looking to play in the futures, the E-minis. You look at that level right here. You see where the breakout level is. You see where that resistance is. So if you're looking to play for some downside and you want to try to do it with a stop, you might look at selling at that 61.30 level. Your first target would be that nice round number of 6,000, and then you're playing for a move back to that 5,800 level. That is basically where it bounced last time, and you see by then you're going to have 5,800 in that 150-day moving average. And what I would also do is look to stop this not too far above where we are, not too far above that sort of resistance line. Maybe it comes in the form of like 61.45 or so. So why am I kind of targeting a 15 handle stop You know what I mean? Because I don't want this thing to get away
Right.
from me, right? And then to the downside, if we start getting towards, let's say, 60, 50 or something like that, then you keep lowering that stop, right? And you're trying to lock in
I
a
think
little
that's
bit of
right.
gains there, manage your risk. And then if you get to that 5,800 level, by the time you get there, you have already taken off a good part of that
You
position.
chip away.
Yeah.
You have a premise, you have an idea. We're trading towards levels. You have to, if you want to be in the game, this basically requires you to do something, especially if you share the same view that we do. And I think you're right. I mean, the level to stop is again through that trend line on the upside, which is 15 or 20 or so handles, and you're looking for potentially a move all the way back down to the 150 day, as you said, lowering the stop along the way and maybe taking some small gains as you go. Here we go with this is now, excuse me, same S&P. Let's go to the next chart because this is going to look very similar, although probably not as constructive. But, this comes in the form of the NASDAQ. I think one of the reasons, Dan, and you know this as well as I do, is because Apple has been a complete underperformer now. Now, if Apple had been participating, chances are my instinct suggests we'd be through it. I mean, you can't do the counterfactual, but here we are. So Apple, even on a day like today where, the market's sort of chugging along, it's really not doing all that much. And that at some point should be concerning.
Yeah, and I think what's important about this chart, and we were highlighting it, I want to say about 4 trading days ago, you see that, well-defined downtrend. It was a series of, lower highs and lower lows. That uptrend line that we drew, it's 2 points. It's not particularly that impactful. We just put it there to kind of show a level in which it bounced. It didn't get down to that 150-day moving average. It didn't get down to those early November lows. So this one really feels like it's been consolidating, however you want to kind of look at it. But it didn't make a new high. And so it's not confirming the new high in the S&P 500. And we look at these NASDAQ 100 E-minis and you say to yourself, we know what makes up the components of this. We know that 10 stocks make up nearly half the weight, which is why the S&P 500 that made a new high, it does speak a little bit to a broadening out. This has become a narrow trade in the NASDAQ. And so if I'm looking at this, and again, I want to take the other side of this, I want to kind of fade this. I'm looking to sell here at about 21,925. That's kind of the level I see. I think right now it's trading at 21,945 or so. In this scenario, I'm looking to stop up there at 22,175. And so again, this is a 22,000 index here versus that last one is about 6,000. So you have to do a percentage basis on what you are willing to risk, right? On what you're willing to sell here. And I'm going to stop that again at, up about 22,175. So I'm risking about 200 handles, which you can do the math is a little less than 1% or so. And then I'm targeting somewhere down near 21,000. You like those levels?
I do. And again, it sort of mirrors what we just talked about before. So I do, and the same rules apply. You have your stop hard and fast. You're looking as if you start to get a winner here, you lower that stop, trailing stop, maybe take some gains along the way. And then you have an ultimate level where you think you might find support and what you're playing for. What I've found interesting, since we've been doing this, and I'm not saying we have anything to do with it, but over the last year and a half or 2 years, you hear more and more people talking about futures as an asset class. And I think the market's really coming along and understanding how impactful and how important these can be. And I think you're going to see, especially as the individual trader investor continues to become more savvy, futures are going to play a huge role, which is one of the reasons we do this.
Yeah, and the other reason we like to quote the CME Fed Funds tracker here, because this is a tool that gives us a good sense of what the markets are predicting for interest rate movements. Here you see at next week's meeting, it's basically a near certainty that they don't do anything. 4.5% of the Fed funds rate on the upper bound. If we want to make, there's no meeting in February. The next one is going to be mid-March. And, again, it still signals, if they want to pull this up really quickly, that there's not likely to be a rate cut, but you're going to start to see the odds, especially if you see moderating inflation data, like I guess the move that we had last week with the CPI. At some point there's going to be some major movement, and again, we can take a look at this 10-year yield chart. There's going to be some major movement based on some of the pressure that the White House is putting on the Fed.
That is exactly right. I mean, that over the next couple months, especially the fact that there's not going to be a meeting in February, I think the pressure that they're going to be under in terms of the rhetoric is going to be immense. Now, I think they're better equipped to handle it now than they were this time in 2018 or so. That's just me. So I don't think they're going to succumb to the pressure. and the market's sort of backing up their reason for not really having to do anything. But it's be interesting to hear some of the voices calling for lower interest rates and how we need to have lower interest rates and our interest rates are too high and all those types of things. By the way, a strong dollar makes all the things that they're looking to achieve actually a little more difficult. And if you recall President Trump's first term in office, he actually talked about the dollar being too strong. So let's see how all this plays out, Dan.
Yeah, and again, we were on the desk. I want to say it was after the election, and maybe it was like late November, early December. And I made the point. This is on Fast Money, and I made the point. He's definitely going to try to push Powell out. He was so annoyed with Powell at the end of his administration last time. And Melissa looked at me and said, well, you can't. It's illegal. You remember there's a lot of, I said, what do you mean illegal? I mean, this guy's, just fact. He's a convicted felon. I mean, he doesn't really care about the rules and the norms, that sort of thing. I think he's definitely, if we get through that March meeting and they don't signal, like downside, to rates and that sort of thing, I think he's going to start putting a lot of pressure. I do not think the markets are going to like that.
Yeah, no, I agree with you that the markets won't like it. A president can fire a Fed chair or a Fed official for cause. If you go back and look at the law, that's what the law states, for cause. Now, cause isn't, by the way, my view on interest rates is different than your view on interest rates. Cause is, for example, if he showed up drunk at work, or God forbid, he killed, those types of things. But it's not because you have a differing opinion on where the economy is or where rates should be. Anyway, there you go. So let's continue this because, oil is a big part of this as well, Dan. And, President Trump wants, obviously, lower oil prices. I mean, he said specifically that one of the ways they're going to combat inflation is to get energy prices lower. Now, respectfully, oil really hasn't done a whole hell of a lot over the last year or so. He's also said that he's going to refill the SPR to the tippy top, his language, not mine, which, by the way, he should. I agree with that. Problem is,
Can you do both? Can you do both? Can you talk oil prices down?
It's interesting, right? I mean, that's
Yeah.
the rub. But I'll say this: he can't, as much as he would love to be able to fill it up today, or of course, by law, there's a period of time like you can't do it. It takes the last thing that I read suggests it's going to take years under current law to be able to refill the SPR. So there's that.
Yeah. Our friend Doug Cass at Seabreeze, he just hit us and said Saudi Arabia cash flow negative with oil at $78. That's basically where we are here. That's going to be a tricky one because it's also, MBS, right? Who basically runs the kingdom over there. They have a really interesting relationship, the Trump administration and MBS, and they rely on them for a whole host of things, to be a stabilizing, kind of figure in the Middle East. One of the reasons why many people thought that, Hamas attacked Israel because they were getting close to a deal with Israel. This was Saudi Arabia to kind of normalize relations and kind of do, a better job at opposing some of the nefarious sort of Iranian proxies in the region. So it'll be interesting to see how they play. And also when we're talking about that Stargate, we're talking about SoftBank, I think like a quarter to a third of SoftBank's capital comes from Saudi Arabia. So again, a lot of
interconnected things. Listen, no question about it. I had a question, so I want to get
on
these
the crude.
No, it's from Adam B. Why do bonds drive the market so much? 5% per year doesn't seem so great. I think, Adam, in my opinion, the only reason they're always important, but I think more so now because this economy and this market got so conditioned to interest rates being zero for so long that they don't know how to really operate in a higher interest rate environment. And just my opinion, this economy is not set up for rates moving to the extent that they've moved higher, nor is, by the way, the stock market. So we're going to see how it plays out. Now, you've seen a couple times along the way where moves in rates have absolutely impacted the market, but it's hard to say that now with an S&P at all-time highs as I'm sitting here.
Yeah, and again, we've touched on this, and Liz Young Thomas has mentioned this on many occasions, and our friend Doug Cass also. We're talking about the equity risk premium, right? So it's the risk-free rate relative to average returns of the stock market, right? And so sooner or later, if you have high rates and they stay high, valuations in the equity market stay high relative to rates, you have a scenario where the risk reward really favors out of equities and back towards like treasuries. And so that's why I think yields affect risk assets like equities so much, Guy.
Good point. Well, let's continue our journey because we have some fun things. Amanda did a great job today. So one of the things one would think, if the economy was as robust as we'd like to think that it is, or if you hear people talk about a name like Freeport McMoran, the stock would be doing well. And anything but. Now, theoretically, we should be at support here. You can see the horizontal line that Amanda drew, and that's correct. And if you go longer term, you'll see that this is absolutely a critical level. But it is remarkable to see how such an economically, theoretically sensitive company has been trading so poorly for so long. I mean, you go back to the spring of last year when this was sort of a $52 stock. I mean, you can see, by the way, this spring's high was the same high we made back in the spring of 2022. But these levels we're at now, if you go longer term chart, you'll see it's pretty critical that we sort of hold the line here, Dan. Nathan.
It's pretty nasty. I mean, if you had a rally back towards 40 and it got rejected there, this thing is on its way back to 30. You know, if you just think about expectations for growth here, the expectation that maybe China's stimulus kicks in sooner or later, right? And you have, you know, global growth starting to catch up with where we are as far as GDP growth is concerned, then this is a name that should be working. Now, the flip side of that, and we can pull up Alcoa.
Right.
So Alcoa is down about 4% also, is that, you know, this tariff situation, the threat of tariffs. I mean, this goes back to what we were talking about. It makes it really uncertain for a lot of these companies. It makes uncertain the buyers of these sorts of commodities, right? You know, we have to go back years now and think about, you remember when companies were stockpiling stuff? When you're stockpiling stuff for fear of future tariffs, that means that you could end up with a lot of inventory. That means that you could have to discount that inventory after the fact, which could be deflationary. You know what I mean? Like, there's a whole host of things. I'm not an economist. What do you say about being an economist?
I'm not smart enough nor humorless enough.
But like, that seems like Econ 101 sort of stuff to me. And so when you think about it, and this goes back to markets don't like uncertainty. What we have now is a whole host of uncertainty on the policy level. And you could basically try to just ignore it. But I think that's going to be a hard thing. You have to more embrace what the chaos and try to figure out what the most likely outcomes are.
We don't have a lot of time. I'll quickly, Amanda, if you could throw up like a 10-year U.S. steel chart, and I'm doing this for a reason to sort of illustrate your point. If you go back to 2016, 2017, into 2018, U.S. steel was lower left, upper right. And look at that chart right there. I mean, I don't know if we can pull a cursor up and just show, but you can see, your eyes can see it. Go all the way to the left, you see where U.S. Steel was trading. Go to the top of that 2018 top. Now, you know what day that was? That was March of 2018, if memory serves. And I bring that up because it was on that day that then President Trump talked about tariffs and the steel industry. From that point on, U.S. Steel never saw another uptick. So, and again, it's not politics. It's just, this is illustrating the point you just made exactly. That not blindsided, but a company that was seemingly figuring it out, and a stock that everybody was starting to get around stopped on a dime on the back of the news of tariffs.
Yeah, it'll be interesting to see. I mean, listen, you know, the Biden administration didn't change much on the tariff front, right? Which I think, you know, but didn't get a lot of, you know, there wasn't a lot of, you know, people calling it out one way or another. I think we can all agree that China dumping their goods and services around the world is not a good thing. And I agree with, I think you and I, going back to the first administration, agreed with a lot of the stance on trade with a lot of these folks. He really set out to try to fix it. He also had some smart folks around him to try to help do that. Let's hope he does this time around. Let's hope it doesn't trigger anything that, you know, we're just not thinking about. And I mentioned this yesterday, Guy, and I think you and I were talking about this. Is like, you know, China to me is not this, you know, it's not this adversary that it was 10 years ago. I think that they've been shown to be a little bit of a paper tiger. No, I mean that, like that. You know, the paper tiger thing. When did that come out? But it's like they have a huge demographic problem. They have a huge like debt problem, much bigger than ours, right? And they just don't have an economy that seems to be working for anybody like whatsoever, unless you are kind of one of the oligarchs. So to me, I think us putting the kind of foot on their neck right now is not going to lead to some decent geopolitical.
Well, that's another conversation for another time. But you know, I've said this along, and I think there are other people out there that agree. You know, when you've cornered a nemesis or an adversary, and you have them seemingly blocked off, I mean, a lot of times that's when they do the most outrageous act to try to get out of that corner. So we'll see how that plays out. Let's go to the chart of the day, because this speaks to, you know, we just saw Alcoa and Freeport McMoran. That's telling one story. Well, This is the chart of the day. It comes in the form of John Deere, which today made an all-time high. And it's interesting because now it's called Deere and Company. This was a stock that was trading sideways, Dan, for a really long time. I mean, basically since 2022, just sort of sideways action. It looks in a lot of ways, if you go and look at this, it's reminiscent of what the Russell 3000 looked like for that period of time before it broke out. Here we are seemingly breaking out. Now, the question is this breakout real, or is this a bit of a head fake and we'll do the back and fill? So that's why I think it's so interesting. For the first time in almost 2.5 years, seemingly breaking out.
Yeah, and just to stay here for a second, I mean, you see like there's some major gyrations here, right? Some major moves higher, some major moves lower. It comes back. Then we had that consolidation, I want to say, from mid-23 to mid-24. The way in which, let's go down to the one-year chart for a second. I mean, the parabolic move that it saw after the election, like a lot of these moves were really interesting. I think we highlighted the breakout then, and then we also highlighted about a month later how it gave it entirely back. So here we are. I don't love V reversals without any real news, Guy. I mean, it just tells you that folks are kind of piling into things. And, again, if I can't find a reason and I can't find, valuation comparisons, and that's not how people make decisions. They don't just say, when the stock was over there at like 403 or what, well, it trades, 2 turns cheap to Caterpillar or something, like, let's buy it and let's keep buying it. That doesn't happen. So I don't love this price action. Let's go now to the 5-year chart. To your point, it's a really nice level here. The back and fill, though, brings you back towards that kind of 405 level, which, again, it's just more gyration. So you better have a good reason fundamentally, technically, maybe some other things that you look at for why this thing is going to establish a new range above 470.
We did the chart of the day just now. Let's do the call of the day, because Amanda did a great job here.
This is calls of the day, Guy.
Oh, sorry.
And we're not meaning
calls
we
of
don't
the
mean
day.
Call options either. So
calls.
You know how
plural.
we have that little thing, Guy, where we put letters together and it makes some sort of thing on Fast Money?
They call that an algorithm.
Well, it's called an acronym.
An acronym.
So mine this year was Gen AI, and I was
AI.
Yeah. So what I was trying to do is pick, 4 stocks that were kind of left in the dust. You know what I mean? This Gen AI trade, and one of them was Electronic Arts.
Oh, hold on. I'm sorry. Gen AI are 5 letters.
Did I say that? Yeah, 5. I can't count.
I mean,
I don't know. I thought I meant DGen or something like that. All right. So,
but
Global Foundries.
Right.
Okay. Competitor to Taiwan
G.
Semi. Electronic Arts.
E.
The N was NXPI.
Sure.
Okay. The A was AMD, and the I was Intel.
Okay. So it's 5.
So just 5 losers.
But you know what?
Losers.
Yeah, but you want to buy the losers in the hope that,
because I said this is a game. This is a game. It's not. I said don't buy this. I said don't buy it, but it's going to be interesting. All right. So you see our street accounts headlines there. So you got a few downgrades. BOFA, that's the Bank of America. BMO, that's Bank of Montreal. And then the last
Ray
one is
J.
Ray J, which is just Raymond James. Let's go to the chart of the call of the day.
This is not good, by the way.
Pretty. I mean, there's nothing to look at this and say, like, so I'm already in the hole by 20%. Not playing. All right, let's go to the longer term chart.
Well, this is, longer term chart, like 109, 110. I mean, that's
110. And by the way, this company has a good balance sheet. They're very profitable.
Would have been nice if the game started like today, so you took advantage of this sell off.
If this hadn't happened, I originally had Expedia in there. And I should have left it as Expedia.
Well,
one thing I'll say is this, okay, really quickly. It's like, if we start getting use cases for generative AI, if companies that are basically trying to implement this technology into their products and services and the like here, you're going to start seeing some productivity gains. A company like Electronic Arts, which spends, tens of millions, if not, whatever, developing games, right? They're going to see the benefits eventually of this technology, and it's going to either, raise productivity or let them cut headcount or a whole host of other things or make better games. You know what I mean? It's just not there yet. I think that's the main point.
It's not there. It's getting close. So it's going to trade. It's already traded 12 million shares, typically trades 2. It's on par to trade 10 times normal volume today. It would be great. I know you don't want to hear this, but if in fact it would trade down to that 110 level, find a little bit of a home, and then maybe you could fill that gap. But, it's amazing in this environment, boy, you are punished if you say something the street doesn't like or doesn't want to hear.
All right. Speaking of that, so we're going to get into the earnings season, and it's going to be largely multinationals for the next week or so. Some of these big tech companies, a lot of them get at least a third of their sales from outside the U.S. I think, and we thought this heading into earnings season, and we're going to hear this term constant currency. A lot of companies are going to report who have a lot of overseas exposure. They're going to report numbers, and then they're going to say, this is what it would be in a constant currency. So without the major fluctuations in the US dollar. Let's pull up the dollar chart that we have, the Dixie guy, really quickly. Listen, a move from 100 to 110 in a matter of months, that's not something you usually see in a currency like the US dollar. Maybe something in the third world, if you like, here. But here we are. We have that really steep uptrend. You see the 150-day, it just flatlined. So when you think about, year over year, quarter over quarter, we're up a lot. I mean, so they're going to have to say constant currency, constant currency. That said, it just broke that uptrend that's been in place. Maybe it pulls back somewhere near that 106 level. That was kind of the breakout level from early December.
Yeah, I think the dollar, well, if I think rates are going higher, it means I think the dollar is going higher. But there could be a scenario this year where rates go higher and the dollar goes lower. That remains to be seen. You mentioned constant currency.
Yeah.
Makes me think of Constant Craving by Katie Lang.
Okay.
Katie Lang. Jacob knows who that is. And Bill Hockman, who's eating a slice of pizza.
There was a company, I think,
Katie Lang.
Constant Contact.
Sure.
Them?
Constant Contact.
It was a software company.
Yeah. I don't know. Or that.
Listen,
there's T, like Constant Comment.
All right, here's the thing. This is really important.
We're doing a show tomorrow.
10 a.m. tomorrow. Okay, this is going to be a really great one. We love doing Fridays, but we're doing it at 10 a.m. You know why? Because neither one of us want to be hanging around in the afternoon.
Neither one of us.
No, we have a lot of
songs by Gladys Knight and the Pips.
By the way, so on Fridays, we have the On the Tape podcast that we tape on Thursdays, drop in the morning. And then if we do an early market call, amazing, because you and I get done a lot of stuff, a lot of meetings, a lot of calls that we didn't get through all week. So that's why Friday afternoons are really important to us.
Mike Wilson drops tomorrow.
On the Tape podcast in your favorite podcast store.
Dan, neither one of us wants to be the one to say goodbye, but unfortunately, that's what we need to do right now. So I've enjoyed this. Hopefully you folks have as well. We'll see you tomorrow.
All right, thanks. Bye. 10 a.m.